Thank you very much, Joan, and thank you indeed to the organisers for letting me be a part of what is, I think, a fantastic panel. The fundamental question here is whether Greek debt is sustainable. And there's a really simple way of answering that because I work for a credit rating agency. If your debt is sustainable, you avoid a default. And what we did last year was we upgraded Greece's sovereign rating to Ba3 on our rating scale with a stable outlook. Now, that's represented a long path of reform and adjustment that's taken many, many years. But it's really important. A lot of people get excited about the difference between investment grade and speculative grade ratings. But for me, the difference between being a BA rated entity versus a single B credit is really where this question of debt sustainability bites. If we are worried as a credit rating agency that debts will be unsustainable and ultimately there will be some form of default, if there's any chance of that, if we think there's any material instance of that happening, we will typically only assign a single B rating at the highest possible outcome. It requires us to have a degree of confidence and certainty that default will be avoided to assign a BA rating to an issuer. So from our perspective, we're sending a very clear signal that we do think Greece's debt is sustainable over the longer term. And the one particular aspect I want to talk about is what Director General Tsakonas just touched on as well. We completely agree with a lot of what's been said by Minister Skyllakakis and by Rolf in terms of the opportunities over the near term with the EU funds coming in and the investment gap and the institutional reforms that are already ongoing that will help speed up the judiciary and deal with the still high levels of non-performing exposures that we see in the banking system. But really, one of the fundamental differences with Greece is the nature of its debt. And it reflects the extraordinary support provided by its euro area colleagues, which often isn't the case where we see highly indebted sovereigns in other parts of the world. The simple fact is the maturity profile, the financing needs for Greece over the next 2 decades even, are not particularly challenging. The government has worked hard to build up a cash buffer. It has very good visibility on when it will need to come to the market and issue debt. And by and large, there is growing investor confidence that this will all be managed correctly. Over the long term, there is still the challenge of how Greece ultimately refinances all of its official sector obligations by returning to private sector capital markets. But that is a very long-term issue. I think as it stands, the average maturity on ESM funding to Greece is still over 30 years, but Rolf can correct me if I'm wrong there. And I think some of the outstanding EFSF funding, which first came into place, is actually over 40 years. So there is a lot of time to deal with this. And importantly, the fact that euro area creditors have indicated their willingness to provide further relief if needed underpins the confidence that private sector investors can have in Greek sovereign debt. It's really important to remember that our ratings, our assessment of Greece's creditworthiness, is only speaking about private sector creditors. We're only ever thinking about whether private creditors see a default and suffer losses. And that matters because ordinarily, if we saw a maturity extension or a cut in a coupon, those are exactly the kinds of things that we would consider to be a default. And if we saw a risk of that happening, you'd see a lower rating for any entity, certainly lower than the Ba3 rating we currently have for Greece. But what we've seen over the past few years is the pattern is that euro area creditors are happy to restructure their own obligations. They're happy to push back maturities. They're happy to cut coupons, although it may be difficult to cut them much lower given the low financing costs that are out there now. And they're happy to do that without imposing similar restrictions on private sector creditors. As long as that remains the case, as long as private sector creditors do not have to participate in any future maturity extension, should Greece require further support going forwards, I think we have a strong case to believe that Greek debt will be sustainable. And there will, of course, be challenges along the way. But ultimately, we want to acknowledge the progress that we've seen over the past few years, the support that's still in place from euro area creditors, and that was why we reflected all of those positive developments in our upgrade to Ba3 in November of last year. And again, if we're doing our job properly, that's a strong signal that we do not expect a default going forwards, and hence that the debt is sustainable. Thank you, Joan.